Good question. It reminds me a little bit of when we were bouncing out of the GFC and companies were posting flat earnings, and we all cheered that, and flat was the new up. So, hey, a 90-day truce, it's perhaps a step in the right direction. I think there's still obviously a lot to be worked out. My hunch is that there will be another truce or another extension, and this could go on and on for some time. But when you look at the different hands here, I think Trump has a pretty strong hand. Now, whether he can try to get something done effectively before he himself has to turn to his own political motivations and his own reelection is an interesting question, which Xi has less of a burning issue around. And both countries have seen a little bit of softness around the edges economically. I'd say China more than the U.S. So, on balance, I think Trump is playing his cards aggressively, but I think that so far it's playing the right way for him in the U.S. And I think that a lot of China's trade partners were probably a little bit tired of feeling like they weren't balanced in terms of relations, or probably rooting for the U.S. in some respect here as well. So am I expecting great change in 90 days? No. Do I think that a truce is better than an escalation? Yes. So I think the initial market response is probably fair.
And Joe, it's interesting that you bring up the fact that China has its own issues with the slowdown going on in the country. The data we had out today, though, from the Caixin PMI, a little bit better than expected. Sure, export side of things wasn't too pretty, but on the domestic side, it does appear that things are holding up. I mean, should that reassure investors across Asia Pacific?
Being based in Sydney, we're certainly rooting for China. I think that when you look at, China buys a third of Australian exports. When you look at China, though, I think kind of more medium term, I have some concerns about their ability to just continue firing stimulus into the system, or rather, the returns on that incremental stimulus. And as they get larger, they keep pumping more stimulus, and they're getting less and less bang for their buck. So I think that something structurally needs to change there, and of course that structural change is pushing more towards consumer, but that's been slow in coming, relatively speaking, if you look at the scope of infrastructure spend. And I think that, my big concern there with China is more medium term than long term, even short term. I have no real ability to predict what's happening there in the short term. In the long run, I think the country has a bright future. In the medium run, they need to wean themselves off debt-led stimulus. And until they demonstrate a willingness and ability to do that gracefully, which they haven't thus far, I think that's something that's a pretty material risk over the next, say, 3 to 5 years.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.